Welcome to Lady Salento Children's Hospital. At the moment, I think we can say the newest hospital in Queensland, and that might change in the next week. So welcome everybody to this fantastic facility for tertiary quaternary care in Queensland. It's the first time that we've hosted any audit event here. My name is Paul Cooper. I chair the Audit Committee at Children's Health Queensland. And we wanted, through the sponsorship of QAO, to just bring everybody together, capture some thoughts, and look for some direction as we go forward. So I'll hand over and welcome Damon to the microphone. Damon is working fairly heavily with Children's Health and in the audit teams across the other HHSs. So Damon, Olive.
Thank you, and good morning, everyone. And special thanks to Paul, Alan Fletcher, Louise, and the team here at Children's for providing us access to their facility. Hopefully this will avoid some of the teleconference gremlins that we experienced the last time we hosted such a session. I'm normally the Health Sector Director for QAO, but currently I'm acting Assistant Auditor General for the Financial Audit Service that we deliver, while we await the appointment of a permanent Auditor General. In terms of the format today, first up you're going to hear from some presentations from QAO. We're going to be talking about topics aimed at improving financial reporting. So apologies to the heads of internal audit. These might not be right in your sweet spot, but really what we're trying to promote, I suppose, in a key campaign for QAO is to improve the relevance and reliability of financial reporting, because we see that as key to improving accountability and then ultimately the information upon which decisions about public services are made. Now, at the end of each of the QAO presentations this morning, there'll be time for some questions. And then at the conclusion of those sessions, we'll break for lunch. There is a rough agenda over here, but depending on where you're sitting, you're not going to see that, the size of this room. Then post-lunch, we'll return and QAO will take a back seat, and Paul will chair a session, a roundtable discussion for yourselves to talk about the topics that are important to you. And at the end of the day today, we've offered, or we've scheduled some time for a closed session just for the Audit Committee chairs. Based on feedback, there was a view that would be a valuable session for the chairs to just have the opportunity to talk openly, and at that time QAO and heads of internal audit, CFOs, can exit prior to the commencement of that session. So first up this morning, the QAO sessions. So as I said, we continue our campaign on improving financial reporting this year. For the last 2 years, we've spoken about simplifying the financial statements and removing unnecessary information in those to let the real messages and the key messages from the financial statements to come through. This has been embraced by most of you in the health sector, and in the last 2 years we've seen a 24% reduction on average in the number of notes that you include in your financial statements. And I think that makes them much more digestible to a reader. It certainly makes them more efficient for everyone to read, including auditors. So we thank you for joining us on that journey. Today, Charles Strickland, who's acting in the Sector Director role for Health. Charles, at the back there, hand in the air. Charles is going to explain how we're assessing quality and timeliness of the financial reports we audit, and how a good year-end close process will help improve the timeliness of these financial statements into the future. Following Charles, we'll hear from David Hardage at the back there. David's our new Technical Director. And David will present on the latest accounting and auditing updates. David's been providing technical advice to the public sector for many years, and today he'll be sharing with us the latest intelligence on what's proving to be, across the Queensland public sector, this year's biggest challenge, implementing related party disclosures. And David will also be talking about changes in the Treasury's financial reporting requirements and the future impacts of both the leasing and revenue standards, which David knows intimately well. Then, following David, a familiar face, or at least a familiar voice to most of you who would hear down the phone in Joe Rapasati, and Joe will be talking to us about our plans for long-form audit reports this year, following on from our example key audit matter that we shared with you all in our closing reports last year. Now, government is the steward of Queensland's public assets, and the valuation of those assets continues to be one of the most challenging parts of our audit every year. It's the single account balance that records the most errors and audit adjustments. Current replacement cost valuations are complex, and today Alan Rucker will be talking us through the highlights and the key areas that always require the most time and judgment from us. Now, wrapping up this morning, the QAO sessions, we'll hear from our Acting Auditor General, Mr. Anthony Close. Anthony's been in the Auditor General's chair since the departure of Andrew Greaves last September, who left us to take up the position of Auditor General back in Victoria. And Anthony has allowed some time at the end of his session for some questions as well. So thank you, Anthony. Now, public sector auditing can really only be effective if there's good collaboration from all parties involved, and the fact that you are here participating with us today, I think, is a sign that we're moving in the right direction together. We're constantly trying to improve that collaboration, and I welcome any feedback from you about how we can do things better. Our engagement and team leaders want to be your trusted advisor, and we want to work with you to understand the accounting issues and risks and to come up with some pragmatic solutions. I guess we ask from you is that when you discuss your facts and figures with us, that they are well researched and well considered. And we also want to be sure that this session continue to meet your needs, and we will seek your feedback at the end of the day via a short survey which we'll email to you. So I hope you all find today's session valuable, and I'll now hand over to Charles Strickland to kick us off. Thank you.
Thanks, Damon. It's lovely to see so many people here today, willing to just devote some time to this sort of update. So thank you. So my name is Charles. I know some of you from my time at QA over the last several years, but not all of you. So I look forward to catching up with some of you at the break. Yep, there's the agenda. So what I'll be talking about is a bit about timeliness and quality. And last year, we really beefed up how we were reporting sort of timeliness and quality and internal control metrics. And so I'll kind of refresh on some of those aspects and talk about what we're going to be doing for this current audit cycle and what we will probably be looking at doing going forward as well. Right, so look, financial statement preparation certainly can be a very time-consuming and costly process, particularly if it isn't done overly well. And ultimately, our goal here is to provide information that users of the statements will find valuable, and they will get it at a time that they'll find useful. And our stakeholders include state governments, federal governments, parliaments, tax-based patients, medical suppliers, lobby groups, yourselves, your staff. Each year, our office certifies over 400 sets of statements, of which 41 are our health clients. And this is why we really need to measure and report on our year-end and quality metrics. So for 15-16, all HHSs met the statutory deadline, which is better than the general public sector. Only 84% met the statutory deadline for the 15-16 year. And certainly last year, all HHSs did too. And I think that's fantastic. That's a really good outcome that so many did. The preceding sector that I was in was the local government, and they only got 86%. So it shows that sector by sector we can get big variations, and this is one sector that really is working well on meeting this statutory deadline of getting information out there in a timely manner. Last year, and just like every year since HHSs have been in incorporation, we've issued clean opinions for all entities. I don't think we've ever issued a modified opinion for a HHS since they've come in. And that, at its highest level, speaks to the quality of your systems, your processes, and the governance. This is a graph that graphs when management at the HHSs have signed financial statements and given them to us. All right, well, I can't use that. This fellow at the end here was actually on the 16th, but for the point of the graph, I thought it'd be easy to put it there. What this sort of shows is that this is good, these red bars. This is really nice to see because it gives us an opportunity to finalise your audit before the statutory deadline. Gives us that opportunity to wrap up all the residual tasks that occur once you guys have had those statements certified. These bars on the end here, the grey ones, these are still when management have certified statements, but I've called them out in a different colour because they're starting to cut it a bit fine, and there's risks there where statements are signed so close to a statutory deadline, and there can arise from unexpected or unknown issues, or even points of difference between what we have been auditing to what has finally been given us. And I call them out just because they do increase the risks. And there obviously is some aspects that we do need to work on, and as I said, we're working on a huge amount of statements, and it would be a shame for us to miss a deadline because we've had an unknown issue crop up at the last sort of minute. But like I said, all I have for the last couple of years met their deadlines. Certainly meeting the statutory deadlines, though, should be seen, I guess, as the minimum sort of standard for measuring timeliness. And that's where we've taken sort of our reporting sort of further. And particularly as we come into this year with related party transactions, these sort of late dates just increase the risk that there's sort of more questions arising from those. So timeliness. Last year we reported on timeliness and about when acceptable draft financial statements were provided to us to audit. Up there on the board you can see we've got three sort of measures, three traffic lights. And what we mean here by acceptable statements are statements that management would be prepared to certify if you didn't need us to go and finish the audit. So that's what we're looking for. Those set of statements that are complete, all your disclosures are in there, you're comfortable with the figures, and you're comfortable with all the other sort of qualitative disclosures that are in those sort of statements. So this year, we're still measuring against those dates we've agreed upon with your management. We're not imposing a date on you. It's the date that suits both you and your external audit teams. However, we would expect that this date would be no later than the 15th of August, and that just allows all of us that time to work through any sort of points of contention well before the end of the month. And certainly better practice would be aiming for early August, just to allow us to work through those. Year-end close processes is something we've always agreed upon with you. Every year in our external audit plan, we have a timeline and a schedule of events that we're working towards with you. We come up to those dates in a collaborative manner about what works for your teams and what works for us. And this year we're measuring those. Now there's dates up there that have been based on the former Under-Treasurer's correspondence to accountable officers from a couple of years ago. We've picked those up and we've continued on with them. Now, not all of these will be relevant for every HHS. Not all HHSs will be undertaking a closed process. Not all HHSs will necessarily need to do asset stock takes. Known accounting issues is one that we might not have any to work through. Where we do have them, though, these are the dates that we'll be working towards. You'll see all these dates are before 30 June, and because these are all activities that we can all complete well before final, which helps take the pressure of your staff, as well as ours, in finalising an audit. I'll quickly walk through a couple of these. So pro forma statements, what we'd expect there is a good quality early draft. Now, we don't need to see year-to-date figures in there, though that would be nice. What we're looking for is updated comparative information, including any narrative disclosures, consideration of all new accounting standards, for example, related party transactions, what you'll be putting in there. Any qualitative text on upcoming standards that you can determine already, for example, the leases and the revenue standards, and any other changes that would reflect operating or structural changes in your HHSs, and certainly any efforts to simplify the statements that you want to do this year. This is a great time to actually introduce them and socialise them with us so that we can provide good quality feedback to you in a timely manner and allow the audit committees also that extra time to work through them. Next on that, there's resolving known accounting issues. Now, the key word there, I guess, is known. There's always the unknown that crops up as we go along. What we're talking about here is prior year issues that we've raised, seeing a resolution towards those. Any other active issues under consideration? You might have complex transactions occurring that we've asked for position papers or that you want to socialise with us, and working towards in-principle agreements. Now, what we'd expect to see, at least from your teams here, is that a consideration has been put into a position paper where you can justify your position and give them to us. We'll be working as quick as we can to give you our position back by 30 April, but we'll certainly take a pragmatic approach to that. As long as we can see that you have put consideration forward to us about your position, then that'll be fine. Next on the list there is non-current asset valuations, and as Damon spoke about earlier, that really is the one that we've seen across the public sector, causes the most angst, causes the most sort of problems, and can certainly take the longest. The reason that's there before 30 April is because it does take a long time for you guys to prepare those, for us to audit them and come to an agreement. There's a lot of estimates and judgments and assumptions that can go into non-current asset valuations. We don't need to see this necessarily processed through your systems, but what we'd like to see is that you've engaged a valuer, that you have agreed on a methodology, and that you can provide that methodology to us, that you've had your material classes of assets revalued, and that you know that what positions you would like to put through your systems by 30 April. Certainly we accept that some entities would rather not process them until the auditors have looked at them, but being able to demonstrate to us what you would process is what we're looking for in this instance. Completing the early close processes, that's where it's agreed, and working to the timeframes that we've agreed with you, and we'll be looking there for the significant transactions and balances reported. And the last one is stock takes, and there we're just after the material classes of assets where existence could be an issue. For example, PP&E, inventory, items valued at cost that might be considered portable as well. Certainly, with these timeframes up here, our teams are working through them with you. We're not going to ask for something, for example, by 30 of April and get back to you in July. That's not fair on you at all. So if we've asked for something by a certain date, we will work super hard to respond to you in a timely manner in that regard, so that we can all move forward with getting the audit done in a good time. Quality is something we've always reported about as well, and has always looked at and measured. We've called out there that no adjustments are required, and that does link into an acceptable set of draft statements that management would sign, and it links into socialising known accounting issues and policy issues well in advance. So, like I've set up here on the slide, good quality as well, we don't expect to see significant adjustments, and certainly we don't expect to see immaterial adjustments processed after providing them to us either, and that's because that wouldn't affect our audit opinion, whether you did them or not. We will obviously socialise with you what we call our score sheet items. You may identify stuff after the date, and if we can agree that they're immaterial, we don't need to see them processed through. They certainly can add time to the process. They can also add a bit of cost from your side and from ours. And finally here, this is how we kind of report this is how we did report in our last report to Parliament that came out earlier in the year. Look, I've put this out not to sort of embarrass or highlight any particular HHS, good or bad, but just to show what our reporting looks like to make sure it's all visible. Across the top here, we've got here, this is all about internal controls and how we assess them. Down the bottom is a key. And what these here are based on the COSO framework. The COSO framework is an internationally recognised framework for assessing controls. And it's not just used by auditors at all, it's used by management for getting assurance that their own processes and procedures are robust. There's 5 elements there. We raise these with your management and with your audit committees and yourselves as board chairs when we find them. What was really pleasing though, we didn't find any significant deficiencies in any HHS this year. What we did find though was there was 125 internal control deficiencies, of which 55% of those related to deficiencies that were reported in a prior year. And certainly this year we're going to be working hard with your teams to work on resolving a greater number of prior year issues carrying forward. Under the risk management heading, which is this fellow here, I'm not using the pointer because I don't think the guys on screen can see that. Under risk assessment there was 4 HHSs who we reviewed who had immature information technology disaster recovery planning processes. And we talked a bit about that in the report to Parliament of the importance of having robust disaster recovery planning in place. For control activities, which is this next fellow, for control activities, we identified deficiencies in managing contracts, approving transactions, and monitoring expense reports. Presenting in this manner has been a desire of Parliament, and certainly we agree that it's an easy visualisation of the results and comparison between HHSs, and hopefully allows you and your teams to talk to other HHSs about how they've implemented procedures and how you can learn from each other. We are applying this consistently to all HHSs, and that's because we see that all HHSs really should have the level of maturity now where you can meet these standards and expectations. This is an approach we've done in the local government sector for many, many years now, and we have seen that it's improved timeliness and quality and resulted in fewer deficiencies going forward. Look, I guess the final thing here is, as board chairs, audit committee chairs, CFOs, what should I be aware of in meeting these timeframes? I've got a couple of rhetorical questions up there. Have you got your committee meetings at the best or optimal time to facilitate an audit process? Are you being briefed on key milestones? Are you aware of what your team is working to? Not necessarily at the level in the external audit plan. It might be at a more granular level, it might be at a higher level, but are you aware of the milestones that are going? Do you know all your contentious issues? Are you aware of what is in play now? Are you aware of what will be coming up in the future? And our audit committees give them the opportunity there to comment on high-risk areas. Are you calling for briefs now? Are you talking with management? Are you understanding the pressure points and the pain there? So look, I'll leave it there. Open for any questions now. Otherwise, if they come up during the session, so
standards as applicable to us. Do you provide information or anything like that to access those changes?
Not all the time, no. So in forums like this, Dave is going to be speaking next on some changes. Contentious issues, we sometimes issue, there's a bit of feedback there. We sometimes issue fact sheets on issues. We've issued a fact sheet on this timeliness, but I think they have. I heard you. So no, not all the time. We don't. Certainly some we do, some we don't. If you feel that your team needs more advice, I suggest you talk to the external audit team earlier rather than later. Forums like this where we can see it's a sector-wide issue, we try to provide a consistent sort of message so everyone's aware of it. And audit teams will be pushing out messages on the ground where it's across the whole sector.
I think to date, the information that's come through, certainly the CFO here has been really useful with some changes that are happening. So he's been quite proactive in helping us with that, particularly for the members on the committee that are not accountable.
Yeah,
I think it's useful to try and ensure that we get that part of
information. Well, the other sort of newsletter, we have a newsletter, it's called Insights, that is on our website. That does talk about bad issues, but that's generally at a whole of state sort of level, unless it is really specific to one particular sector. But that comes out on a quarterly basis. If you've subscribed to our website, that'll come directly to you. Otherwise, they're all up there and you can download them at your leisure. Yes?
You indicated that the draft financial statements were to be delivered by the 15th of August. Has that been clearly articulated to the external audience? Because from our HHS, one of the issues has been where we've got our board meeting, when we've got our ARC meeting towards the end of months, on many occasions the draft financial statements have been coming to us, providing us with very little time to be more towards the right side. So my question is, has that been clearly articulated to the external auditors that those statements must be in the hands of board ARCs by the
All audit teams should be aware that 15th is a desirable date. Now, it's not a date that we will measure you upon. The date that we'll measure you upon is the date that we agree with you. We've called out the 15th as a better practice date to allow timely working through of papers and issues and documentation. So the team should be aware that they're working towards that. If you're finding that that you're not seeing that, I guess now is a really good time to have the conversations about when are we going to get in at our meetings at the right sort of time to facilitate that.
Eric, just add a comment to that. Charles was talking about the date by which we would request audit receive the final set of statements, which gives us about 10 working days then before the end of the month to finalise the audit of those set of statements and provide the clearance back to national to sign. That's not the date that Charles indicated by which we should refuse the audit to be clearance back.
Yep.
I don't know about the other ARCs, but that has always been a critical issue for us in terms of when we get final statements, it puts a significant amount of pressure on accountability to ARCs and also the board, that we're constantly rushing to meet board deadlines. Now, we know that in the past we've readjusted when we have our ARC meetings to be aware of everything that all these topics. But I've been rather critical in past years of our finance team, where I've said it's pretty hard for us to put pressure on the external auditors if we, within our service, have not met the agreed targets that we've set. So last year, I particularly was harsh on our team to say, if you want me to pursue these issues with external auditors, we've got to make sure that we meet all of our targets, which they did, but it still did not change the fact that we were under extreme pressure towards the end of August to really look at the statements and dissect.
Look, I agree, and this can be a problem not just in health but in many entities, and that's why we socialise a draft sort of time frame with these sort of milestones in them to allow people to say, do I have enough time to achieve these outcomes? So your management should have an opportunity to look at those in advance. We should be socialising that, all audit teams should be socialising that with the audit committee chair as well, to give them that opportunity to say, is this enough time for me and my audit committee to get across them? So please drive your teams and speak up if you feel that you're not given enough time to look at things. If there's no other questions, I'll hand over to David. Certainly, if you do have questions on this topic at the very end, I'll be more than happy to come up and take some more, or you can come and find me at lunch. All right, David.
Thanks, Charles. As Damon mentioned, I've recently joined Queensland Audit Office. I've been involved in providing advice in the public sector for many years while I've been up here. I was involved with some of you with the separation of the HHSs and producing your financial statements for the first time some years ago, and the odd bit of advice since then. You may have also seen me present on accounting topics at the various accounting bodies over the years. To pick up the question on the accounting standard changes, each year can be a half a dozen changes in accounting standards, some quite small, something called annual improvements. Others are minor amendments, and some of the big ones. So the aim today is to give you an overview of the more significant changes for this year, which is the related parties and the key management personnel changes, and to just give you an overview of revenue and leases coming through, but there are other standards coming through. So we do want to give you an overview of the big changes, but in terms of have you given us some background into every single change? No. So the two sources, as Charles mentioned, well, the one source, as Charles mentioned, is the insights, and we have been covering key management personnel and related party transactions for over a year, and we've got revenue and leases, I hope, in this one. The edition about to be issued. And you've also got the Queensland Treasury financial reporting requirements that are actually being issued in draft, and they'll list the new standards as a double check as well. So what I want to start with is the. Sorry, I'm just trying to work out the button to go forward. Sorry, down button. Okay, the last one. No, I've click something that's making, there we go, sorry. Okay. This is the big one this year. So we've talked about this for a while. As I mentioned, some articles in Insights. It's now crunch time. We've now got to put the disclosures in. And this is the topic that could well delay your financial statements if you don't pay enough attention to it. So when Charles spoke about pro forma financial statements at the end of April, he did mention key management personnel and related party transactions. So the idea is to try and get some idea of what you're going to disclose, which I'll talk about in a moment, rather than just having a to-be-filled line in there. So we're looking at that to be a bit more advanced. So when we talk about the standard, it's often described as applying the private sector standard to the public sector. And to some extent that's true. But there are two private sector standards on this type of related party, executive, key management personnel disclosures. One is for the listed companies, which is very, very detailed. Essentially, everything is material, everything gets disclosed. The other one, which is the one we're going to be applying, is for the unlisted companies. Now, we're going to apply a lower level of thresholds, although this is then applied over your existing requirements for disclosures. So it does get quite confusing. So there's probably four main areas to look at when you're doing your financial statements, and I'll give you an overview of each of those. So to keep in mind, this is the objective of the disclosures for essentially unlisted companies, because as I said, listeds have very, very detailed requirements. So the main point of this is that we're looking at the materiality in terms of the financial statements as a whole. Now, we're still looking at materiality both from a quantitative and numerical perspective, as well as a qualitative, sort of other facts and circumstances. So there could still be things that might be considered small if you looked at, okay, we've got $100 million worth of revenue coming in, what's 2% of that? 2 million. No, we can't just say anything under 2 million, exclude. So there could be some transactions with a lower amount that need to be disclosed under the qualitative side of materiality. However, it is not a transparency accountability type exercise where every single transaction with the particular people disclosed and everybody else makes their own decision of what's relevant to them. We're looking at the materiality and the objective for the financial statements as a whole. So the first change is sort of not a change for you because you already have disclosures required for remuneration of key management personnel. Where the change comes in is that the standard has been changed to clarify that potentially a minister of a state government entity gets included or may get included as a member of the key management personnel disclosures. So we're still getting official confirmation. So I think the official version is that the agencies, such as yourselves, HHSs, have to make a decision. Do you think that the minister is included? Then don't ask the minister for information to be disclosed. That'll come to you later. You may, I think, tell the minister what you've decided, but hopefully all this will get decided and clarified very, very soon. In practical terms, for the remuneration disclosures, if the minister is included as the key management personnel, you don't pay the minister anything, so there'll just be one line disclosure saying the minister's part of the key management personnel, but we don't pay them anything. What I want to highlight in this particular area for disclosures is, have you got the key management personnel right? Now, what I'm talking about that is that I picked 3 HHSs sort of at random, and when I looked at the key management personnel and I looked at the number for executives, in addition to the board, the number of executives varied from about 12 to about 20. Now that, from my background, private sector is a very big number. Now, normally I would be looking at what the standard is looking at, which is the definition at the top. Who are the people involved in running the entity as a whole? You normally get a handful of people that report direct to the CEO, and it's that handful of people that really make the decisions. And generally there's a wider group of people who come in and get together, a wider team, and they're just responsible for their own particular areas. So they have a variety of names. So that wider group, the people aren't necessarily making decisions for the whole of the entity. They're just making and providing input for their own particular area. So it does get a little bit political in who's part of the executive management team. But the purpose of the standard is looking at who are the people responsible and have responsibility for the entity as a whole. And I would think that it's less than the 12 to 20 that I've been seeing. So in the past, it hasn't really mattered. It does matter this year because we're going to have to disclose and collect information based on the transactions that those key management personnel have had, board members, as well as the senior executives have had with the HHS. Not just them, but their close family members and their controlled entities and jointly controlled entities. So you may want to have a closer look at who you're including and who you're collecting information for. The other practical area that we're having some issues with sometimes is people in acting roles. And again, you've got to look at the purpose. Who are the people responsible for making decisions? So if someone's in an acting role on a temporary basis over Christmas, which we see sometimes in drafts, have they actually made any decisions? Were there actually any meetings that were held that made big strategic decisions? Or are they just filling in for someone on an operational basis for a couple of weeks? Now, there's an extent. So, we've already mentioned Anthony's acting Auditor General. So, he's gone up. He's been in that role for a number of months, as well as Damon's been in his role for a few months as well. So they're more into potentially getting included in this if they weren't already, while the annual leave, Christmas break thing is probably not ones that you'd necessarily include. So this is the process. Sorry? Yeah.
We historically have reported the kind of broader management team, probably for remuneration purposes. So do I interpret what you're saying is that we should now reconsider both for remuneration purposes and related parties, or are we talking about two separate?
We're talking two different things, but they get merged. So when we use the term executive and management, we're looking at a particular definition in the accounting standard, which is different definition to the SES level. When I looked at the rules, Treasury said when you're looking at the accounting standard, make sure you're consistent with your disclosures in the annual report on the management executive team, if I have the term right, but I couldn't find a definition for that. So it's like the particular HHSs I've looked at define themselves, here's the management executive team for the annual report, and then made the disclosures consistent with that. And I can see why they've done that, but it is wider than the accounting standard. So it's a little bit political because there's some very senior people, important people who are executives, but when you look at the accounting standard, they're only looking at their own particular area, and they're not really the ones the accounting standard's designed to pick up. It's the level above, is what I find in practice. Now, I haven't been involved enough to know whether that's true. It's just an area to look at to try and simplify things.
Can I ask a question, please?
Yep.
Some HHSs may be doing this, but getting someone to present to our board and the senior management group, Northwest is, there are implications of this that you just can't get from a document that you read. People have got questions. We've had one iteration of a discussion at our board about finance committee on related party transactions. There's quite a, not so much complex theory, but people need to understand, particularly the directors and the senior staff. Are there people who give presentations on this where you can have an interactive process to make sure all the issues around it are properly covered off? Does the QAO do it, for example, or is there someone else who does it? So I just think it's very important for people to have the opportunity to actually have one presentation where you can have it informally and discuss the implications of this.
Today?
No, well, my board's not here.
Okay, so I misunderstood the scope of the question. Yes, through the engagement team leader, through the sector director, whoever you're involved with the audit, then we can work through something.
So the external auditors could do it?
Yes, they should be able to do it. So you have an auditor other than QAO?
Well, we've got
Okay, well they should be able to do it. If you're finding a trouble because they're not necessarily looking at this for the public sector in detail, I mean, they're used to it for the private sector, then I'm happy to be involved through whoever the contact is through QAO.
Any other HHS in the same directors fully understand what related party transactions are all about, what their obligations are?
Richard, I thought I did until I saw a couple of the comments here. So that's opened up a couple of issues for me. And I sat down to complete the related party disclosure document last night, and I'm one of 6 in my family, and I've got 4 grown-up children, and I'm a board member of another number of companies, and an owner of a number of companies. I started looking through this and the matrix of who's included, and it gets too crazy. Yeah.
I mean, there's a lot of sensitivity around this with some board members. About going right down that path with children and all that sort of stuff.
Well, it's got your brothers, sisters, cousins, aunties, uncles, nieces, nephews, in-laws, family members, and their partners of all of the people in this other category. Just go, look, you haven't seen my family tree. It's great.
It's a very important point. So the definition of close family member, which potentially brings in that, is very vague intentionally, just to allow for different circumstances. This is a international private sector standard. So there is a definition part of the definition is a rule. It brings in children, including adult children, as potentially affected. Doesn't bring in parents, though they could be picked up with the definition of close family member. I think the way I'm looking at some of this is that some of the children aren't going to be involved if they're under 18, for example, as long as there's no shareholdings and all the other stuff. So there might be an easy way to say, I don't have any children who have businesses, and then leave it at that. So I think that there's ways to make it practical. And what it's looking at is what are the transactions with the HHS. So I can see where directors who are also doctors having practices get included. So where else are you going to have a significant transaction with an HHS that is not part of going to the hospital as part of a normal citizen? And I think it's trying to get that on a practical basis.
Supplies to the hospital are outside that area.
Sorry?
There's a lot of other supplies.
Yes. And that's part of it. It's someone's collecting the information and then potentially filtering it out to say, well, this is fairly minor. The selection of that supplier is completely independent. So some of the examples we've got is local councils, where they may not have gone through a tender process. That makes it more material. So again, it goes back to materiality, trying to look at the financial statements as a whole, not necessarily disclosing every single transaction and then someone makes the decision. So that's what I want to try and differentiate between the listed companies, which everything is material and everything gets disclosed, versus what the unlisted standard requires.
Excuse me, David. It's Danielle from Torres and Cape. It's impossible to hear the conversation from the floor. Is it possible a microphone can be sent round, or if you can repeat the questions for those of us on VC? Thanks.
Okay, thank you. Sorry, I'll repeat the question. So the question was related to the form that seem to be very extensive. It is because it's essentially for everyone in the public sector. And then I think it's tailoring it for yourselves in some cases and talking to the people involved who have to fill out the form, what the form is intended to do. And then potentially having one-on-one discussions with them if they've got lots of children and those children have businesses.
So situations where we've got a board member who also runs sessions in the public health system, or even more specifically in this hospital, if we're talking about CHQ, does that full disclosure need to be made, including remuneration?
Okay, so the question is we've got a doctor who's also providing services to the hospital, who's a board member. So that goes on to this slide, which is the disclosure. So potentially, well, we start off with identifying the person, identifying the relationship, identifying the transaction, then we analyse it to work out whether it needs to be disclosed. Now, what is the volume of the transactions? How did that contract come about? Was it through tender and what have you? And then the accounting standard actually doesn't require disclosure of the person's name or the related entity's name. So, which raises the question, if you don't disclose it, then who is actually involved with it? So there's some flexibility to have generalised disclosures to say these disclosures exist. And then we look at the information and work out what is the important point, usually the amount of the transaction. But if you go to the standard, it's got a checklist of what you should disclose. And one of those things is the balance owing at the end of the year. Usually that's immaterial if they're on normal terms and conditions. So it's a potential transaction, and I'd need to know more, and you'd need to know more about the extent of it to work out what disclosures, if any, are required. So I'm not saying it has to be disclosed. It's one of those funnel things where it starts up here, and yes, it might need to be disclosed, it may not be.
But at some point, that person that we're looking at would need to provide that information to someone.
Yes. Well, it could just be starting off saying, yes, I've got this relationship, and then taking it further without necessarily filling out all the details in the form, in amounts or whatever the form asks for. So it's first identifying the transaction under the process and then analysing it.
That just adds to what I was saying before, that board members, in particular, the remote location right out, no disrespect to my colleagues, they aren't necessarily as well informed on issues such as this as they might be in the metropolitan.
Yep.
And we really need some sort of presentation, which I'll try and arrange after this, so that people can have, through an iterative process, the opportunity to ask sort of similar questions to what Paul's asking. I don't think our guys at the moment understand the implications of this. And they need to be talked through in a careful and considered way to make sure they understand it before they fill out the form. Because at the moment when you're filling out the form, they're saying, what the hell have I got to do this for?
Okay. So going back to the point about hearing the question, so it's about making people aware of the changes. We have included articles in Insights over the last 12 months, and I think it's particularly the last two, would be the most relevant, December and I think September last year. Okay, I'm going to sort of... Sorry.
Charles, previous session, there was an option to subscribe to QAO's website. I can send you a link to that in the same email, where you get advice on new reports Parliament have been tabled, the Insights magazine brochures is published, and also in their practice guides published.
Okay, so for those on the call, there'll be links to sent out to subscribe to these.
Al, is this one that you did for us, or is this the declaration of related party transactions.
That's the standard version. That's out for everybody, right?
I'm going to sort of give a very high level overview of the other changes coming through. So the way that the accounting standard is written, potentially members of Cabinet are included as an other related party, and there may be disclosures with if a member of Cabinet has a transaction with an HHS, particularly if they're a doctor or someone who's still practicing. Treasury are still to define how they're going to collect that information, and it will be collected centrally and given to you. There is some disclosures relating to transactions with other government entities. They're simplified, so you shouldn't have to have too many more disclosures with that, because often the disclosures you are having with other government entities, they're already described as transactions with government entities such as funding. So just have a close look and make sure that if you find that they're too detailed, then it probably means that you haven't taken advantage of some of the exemptions that you've got. FRR changes. The main one here is to do with key management personnel related parties, but also with budgetary information. So when you've put in the budgeted financial statements in the notes, you're now allowed to put that on the face, and that might help with the explanation of planned deficits. So if you have a deficit and that was planned, and you also have that on the face, that might help in explaining things. These are the upcoming changes to standards. So I'm just going to give a very quick overview on income and revenue. The main issue that people have had problems with is getting the money in 1 year and the expenses in the next year. So there's been rule restrictions as to not being able to match that. There has been some changes that may allow matching, but they're going to be very difficult to get. So when I looked at some of the HHSs, it seems that a vast bulk of the funding, whether it's called grants or what have you, is coming in the particular financial year and sorted out in that financial year. So didn't seem to be a lot that go across the financial years, but it's not just you as the hospital, it's some of the other entities that you're involved with. And I was involved with one funding community type arrangement where there's a focus on preventative care. So that was some sort of multi-year program that might get caught under the new rules. So have a look at what your funding arrangements are, and if you've got some that span a financial year, then this is one that you'll need to focus on in the future. This is timing. If you're giving grants out to other organisations or funding to other organisations, they may come back to you wanting a rewrite in some of the clauses so they can get deferral. So depending on the transition provisions, even though it starts in 2019, starts a long way away, if you come back a bit, then you may need to be starting in the next within the next 12 months on some of this work. Operating leases. So finally, they've got an accounting standard to put operating leases on balance sheet. When I looked through the HHSs, the vast bulk of your assets, of course, is in the hospital buildings. There were some operating leases. They're the ones that are going to cause issues because the actual mechanics of the calculations is quite detailed, quite complex, different to what we're used to. So they may be things such as rental for accommodation for patients. It might be office buildings and the like. One hidden problem could be rentals. So I've seen some examples where there's a rental arrangement for equipment or testing equipment with the hospitals. It's a whole of life arrangement where here's the piece of equipment, we'll maintain it for you. The old system would be operating lease and service expense that just got expensed as it went. Under the new standard, potentially there's an embedded asset in that arrangement, and that asset may need to be recognised on balance sheet. There are some exemptions for small value equipment below $5,000 US and terms less than 12 months. So.
I ask a question about one of the challenges we have is with John Slaven from Sunshine Coast. One of the problems we have over and over again is suppliers coming on to our sites and talking to the clinicians and bringing in the latest piece of equipment and say it's only worth $1,000 or $1,200 or $1,500 or something. And then they sign them up to an operational support agreement where there is exclusive right to supply the consumables for a piece of equipment. You might use a piece of equipment once a month, $25,000 for the consumables, or you might use it 100 times a week at $200. But essentially the capital component is built into the price of the consumables, and it's a huge issue for the HHSs. How will that be impacted by this?
If the piece of equipment, if it was bought new, was less than roughly $5,000 US, you can exclude it. So you don't have to account for it, like photocopiers, PCs. So you mentioned 1,000 gets excluded. More high value equipment, over the 5,000 US, then potentially would have to be accounted for as an individual asset. And complex calculations in splitting capital component and consumables.
But isn't the key in that one? Isn't the key?
The key is the 5,000 US dollars.
Well, the key is the 5,000, but AASB 116 kicks in the value of the equipment, not the cost you paid for it. So if it's only $1,000 cost, but the value of the equipment in a lifetime use, then there's got to be a valuation done, and that valuation might be 100,000.
Okay, okay, a very important point. So when I'm talking about the value of the equipment, it's not the cash component of the upfront fee. It is if you purchase the equipment, even though they may not allow you to purchase it, what would the value of that item be had you purchased it? So if you're talking 100,000, then that's the value you use. If it's a smaller piece of equipment that would cost $1,000 to purchase, then it comes under the 5,000 limit. So it's not the cash payment that they ask you for, which might be nothing because it's all built into the fees. It's what that item would be worth new. Okay, that's just to the slide. Next slide is to show you the effect on profit. The next couple of slides is focused financial reporting that was spoken about already. This slide is just to focus particularly on charities. Those of your registered charities may have to report under two pieces of legislation. So your management certificate would have reference to the Financial Accountability Act as well as the ACNC Act. But some of the other entities you're involved with are companies, and they will only reference the ACNC Act. And so I've got a list of questions that are there for you.
David, can I go back to the KMP discussion? The bottom part of that slide said other considerations, and one of them was materiality. And in assessing that materiality, are we applying materiality at the organisation level, or are we applying it as, is it material to the key management personnel? So, for example, if it's a $500,000 payment to a person, it's not material to us in our near $1 billion budget, but it might be, it certainly would be to an individual.
Okay, so so the test is not materiality to the key management personnel themselves. It's materiality you, which is a combination of the amount, the 500,000, and then it's the nature of the transaction. So even though it may not be material in terms of your expenditure, it may be material in terms of how that transaction came about.
I don't understand that.
Well, has it gone through normal purchase procurement processes? Has it been open to tender? What other particular aspects of that agreement, if anything, are there? So it could be that if it just goes through the normal process and it went through tenders, then there's more likely not to need to be disclosed. Transactions with KMP that don't go through tender are more likely to need to be disclosed. So it goes back to the objective of the standard as to informing people these transactions occurred, and essentially if that transaction would not have occurred if that person wasn't a KMP, then it's more likely to be disclosed. Okay. I'll hand over. Sorry. Thanks, Damon.
Can everyone hear that? As Damon said, I'm the mystery QAO voice that you hear down at the phone line at your audit committee meetings. When I dial in, that QAO representative, that's me. Long form audit opinions. As you'd be aware, QAO is adopting the long form audit opinions for all HHSs from 30 June this year. This has resulted out of the new Australian standard ASA 701 communicating key audit matters in the independent auditor's report. There will be some changes to the independent auditor's report that you've seen previously. Sorry, there we go. One of the first changes is the audit opinion itself will... All right? Sorry. The audit opinion itself will appear as the first paragraph in the independent auditor's report as opposed to the last paragraph where it's been appearing in over the last few years. There still will be paragraphs in there with managers' responsibilities and auditors' responsibilities. There will be a basis of audit opinion paragraph, which is essentially outlining how we've conducted the audit in accordance with the auditing standards. And previously that was part of the auditor's responsibility section. But probably the main difference with the long form audit opinion is the inclusion of an additional section identifying the key audit matters, reporting on key audit matters. So this section won't impact on the audit opinion itself, but it will provide a description of why key audit matters are being included in the independent audit report and how we've addressed those matters through our audit procedures. So what is a key audit matter? A key audit matter is essentially those matters that in our professional judgment were of the most significance in our audit of your financial statements for the current period. So generally all key audit matters, we'll select those key audit matters from all of those which we're obliged to report and communicate with those charged with governance as required by Auditing Standard 260, communicating with those charged with governance. To identify the key audit matters, we consider the areas assessed as high risk of material misstatement in your financial statements. We look at the areas that involve significant management or auditor judgment and take into account the effect of any significant changes or events or transactions that have occurred during the current year. So this could include matters such as audit matters requiring significant attention, any changes, significant changes to your accounting policies, major accounting policy concerns, or any potential disagreements that we might have with management. So essentially, we start a filtering process where we look at all issues that we need to communicate to those charged with governance and filter them down, looking at those that are more significant, requiring auditor attention and further significance to your audit itself. This assessment sort of ties back to the external audit plans that we provide you. In those external audit plans, we identify all of the areas of audit significance that we see as part of your, as requiring significant auditor attention in your audits. So that includes the things like valuations of your property, plant and equipment. Your activity-based funding generally tends to be one of those. And also the provision of your payroll and expenditure services by your audit service provider, sorry, not your audit service provider, your HHS service provider. So from there, we filter those areas of audit significance down to those that we see to be of the most significance to the audit itself. They then become the key audit matters that we would report on. There's three components to key audit matter reporting. First part is the details. That really looks at and identifies the actual matter that we consider to be significant. So that'll be something like your valuation of your building at your current replacement cost. We identify what the issue is. Now, what might be significant in 1 year might not necessarily be significant in following years. It may just be a one-off issue that we're addressing and may not apply in future years. In addition, as part of the details, generally we will cross-reference back to any relevant financial statement note disclosures that are included. So if we are including financial evaluation of your property, plant and equipment, we'll refer back to that financial statement note disclosure that's in your financial statements. And generally, the CAM details will also just describe the assumption or the estimate or the judgment that we're proposing to assess. The second component is the actual audit. So it's our approach to the matter. What are the key procedures that we are undertaking to address that risk? It won't necessarily list all procedures, but only those key ones that address the risk that we've identified. And the third component is really just the outcome. So how was the matter addressed, and what was the outcome of the audit procedures we undertook? We won't necessarily be providing a separate conclusion or opinion on that key audit matter. We still only provide just the one opinion as part of our independent audit report. So there's no individual opinions expressed on any of those key audit matters we identify. So what do we think could be a key audit matter for the HHSs? The main one that we've identified is really around your assets, the valuation of your property, plant and equipment. Property, plant and equipment really represents, for most HHSs is about 75 to 80% of your balance sheet. So it's the largest balance in your financial statements. So it is the component in your financial statements that has a significant number of assumptions and judgments required to arrive at that final valuation. So it's certainly one that we identify as having the most risk for the HHSs. Potentially one that we are considering this year is around the accounting treatment for the PPP arrangement for Sunshine Coast University Hospital. As I said, it's a one-off accounting arrangement. We need to understand and be happy with the transaction that's occurring there. So it's something we're having a look at the moment in terms of that space. And again, that would just be a one-off. Once that accounting treatment is resolved, we would take that no further. So what will a CAM look like? Won't look like that. There we go. There's a little bit more of it. So that's basically a bit of an example of what a CAM might look like in our long-form audit opinion. So as you can see, it identifies the nature of the key audit matter itself, being valuation of buildings at replacement cost. You'll note it's making reference to the relevant notes in the financial statement, so we're going to be referring back where we can to any relevant disclosure notes in the financial statements. The commentary provides a bit of a description around that it's a material value of the assets, they're specialised in nature, and there's a whole lot of significant assumptions and judgments used to arrive at that valuation. It also identifies the key assumptions or estimates used as part of the valuation model, and then also provides what are the key procedures that we've undertaken, and within that also the outcome of those procedures. So ideally what QAO would like to do is have the wording for these key audit matters and our long-form audit reports discussed and finalised with management around the same time that we're doing our pro forma statements and providing the feedback on those and the commentary on those. That might be a little bit protracted this year because the valuations we've got until 31 May this year. So really until those valuations are finalised and we know all the estimates and judgments that are used in that, it's going to be a little bit difficult to be able to finalise those at the same time we're finalising pro formas. But I think we can get the guts of it pretty much finalised by then, and then tinker around the edges with most of any further wording that we need to. But certainly we would like to have it completed by 30 June so that all parties are happy with what we're proposing. I guess over the last year or two, we've had a bit of a strategy at QAO in terms of how we're implementing this long-form audit opinion. Last year, we had a bit of a trial run across most of our the government sector, the GOC sector, and also HHSs by including an example of what a CAM would look like in our closing reports that we provided to HHSs. This year, it is basically the full-on reporting of these as at 30 June. So for departments, HHSs and GOCs. Now, obviously, there are a number of other entities such as other stat bodies that fit within the whole of government. Those entities are smaller in nature, and it's up to the discretion of the engagement leader of each of those public sector entities as to whether we pursue a long-form audit opinion or key audit matters in those entities this year. And it could well be that not necessarily all entities will have key audit matters to report. You could have a policy department that doesn't have any significant property, plant and equipment, only has payroll expenditure and some general very small plant equipment items. There may be no key audit matters involved in that particular entity. So it's not as though every agency needs to have a key audit matter. Those rhetorical questions that come around, or what can you guys do to assess? I suppose the key thing is our audit committee is going to be satisfied with the level of disclosure included in your financial statements around asset valuations, in terms of us being able to reference those in our opinion. That's one of the areas that it'll be part of the review that you do as part of your financial statements. But I guess management needs to be comfortable that those disclosures, you're happy with what's in there. And I guess the only other thing I could think of is for audit committees to think about, are there any other potential key audit matters that might be out there that you need to consider and maybe discuss with your auditors? As indicated earlier, we're not expecting to have too many others, but if there are any concerns that you do have, please raise them with your auditors early, and we'll look to work with you to address those. Any questions? No? All right, thank you. I'll hand you over to Alan Rucker, who will talk to you on asset valuations.
Which way does this go? I guess most people don't know who I am. Everybody hear me? I can hear myself more than I could hear Joe. I am currently the team leader for Metro North, Sunshine Coast and Children's HHSs. And in the past, I have been involved in the audits of Darling Downs and Metro South over the last 5 years. So I have been involved in the health sector, just not dealing with yourselves as much as I will be this year. So we'll start off with property, plant and equipment on the balance sheet. It makes up approximately $10.7 billion, which is, as we know, a significant part of the balance sheet, 80% of total assets. And of that, 8.8 billion or 82% is revalued or disclosed at fair value every year, that being land and buildings. And as can be seen on the slide, there's capital WIP currently in there. These numbers are as at 30 June 2016. There is approximately $1 billion in capital WIP, which makes up 10% of property, plant and equipment. This includes the 16 HHSs and the department. And included in that capital WIP is a large amount for the Sunshine Coast new hospital. So that will be transferred across to buildings during this year, and therefore that will increase that amount that has to be revalued or declared at fair value. Obviously, the new building will be at fair value when it comes across, so there won't be a new valuation needing to be done. It'll be done as part of the transfer. So of that amount, 72% of property, plant and equipment are buildings, and buildings is where the more complex valuation is to be found. If we move through, where are we? Fair value. Fair value has been around for a little while. It's very theoretic. It's in theory, it's pretty straightforward, but in practice, it can be rather complex because of the assumptions and the estimates that are involved. The definition of fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And the objective of the fair value measurement is to find that value. And there are three levels of inputs, starting with, is there a market and the market value? Mostly in the health sector that applies to land, because there is an active market in land in most parts of the state. So land normally falls into that bracket, and that makes it an easier valuation. The second level is where there might not be an active market for the particular asset, but there may be one for a similar asset that can be adjusted to meet the asset in question. And again, there are not very many of those in the health sector. Most in the health sector fall into the third area where there is no active market and an estimate has to be made. And there are two approaches that can be covered, either the income approach or the cost approach. The income approach is based on future income, the present value of future income. There are probably one or two buildings across the health sector that are valued using that approach. The majority of buildings are valued on the cost approach. How much would it cost to replicate the future? I lost my place. Well, the current replacement cost of the building in question, not necessarily a brand new building, but the cost of a brand new building adjusted to make it like the building in question. So as I said, the more common method for valuing non-land related assets in the health sector is current replacement cost, or sometimes referred to as depreciated replacement cost. The new name is current replacement cost. So to determine an asset's depreciated replacement cost, valuers estimate the minimum cost that would be incurred at the valuation date to replace an asset's whole-of-life service potential, excluding any permanent excess capacity. To establish the cost of replacing service potential, an entity should identify the modern equivalent asset. The modern equivalent asset is the asset that would be constructed or acquired today, reflecting modern design, modern materials and construction techniques and safety standards, but without any gold plating. In measuring how much someone else would pay to acquire or construct a substitute asset of comparable utility, this method presumes that a hypothetical buyer would not pay more than the amount that they could build a new building with the current, that would replicate the remaining service capacity. So if they were going to build a new building with the service capacity embodied in the current building, how much would they have to pay to build that building? So the full replacement cost of a building would have 100% service capacity embodied in it, whereas your building has less than that. So there needs to be an adjustment made. So it needs to be adjusted for any permanent excess capacity. So the new building might be bigger or better, and that needs to be taken into account. And sometimes that modern substitute asset possesses utility or components which are not present in the current asset. For example, they might have mobility support. They might have air conditioning, and some of our country buildings don't have air conditioning at the moment. The cost of the modern substitute for this extra utility needs to be adjusted to give the cost of the modern equivalent asset. And it is our view that the financial statements should reflect the modern equivalent asset to prevent overstating the value of the utility that currently exists. And the asset condition is again another element that is essential in this measurement, because the asset condition is used as a proxy for determining how far through its life an asset is. And various consumption patterns have been used by valuers over the years to estimate how useful life is measured in a period of time. Most infrastructure assets controlled by not-for-profit public sector entities, including your sector, the health sector, they contribute the same level of service in each year that they are operational, even as the condition deteriorates. So a hospital provides the same service from year to year, even as it gets older. So in our view, a well-utilised hospital building gives approximately equal benefits to the community from one year to the next until it ceases to exist or ceases to be in use. So even if the condition of that building declines significantly, the impact is on the remaining useful life, not on the value provided to the community during the year. And if a component's current condition deteriorates more or less than expected during the year, that impacts on an adjustment to the remaining life or the total life, and thus an impact on the fair value of that component or the building. And relating to that component of condition is the remaining useful life. And there's currently a question across the government sector around how well asset records are kept and asset valuations, how are they being used by management in forming asset decisions. We contend that accurate asset valuations will provide relevant and reliable information for decision making on effective, efficient and economic management of all of these assets. And that's critical to the ongoing sustainability of government service delivery, including in our hospitals. We all know that under the accounting standards, an asset's useful life must be reviewed at least annually. And if expectations differ from previous estimates, the changes must be accounted for. These useful life reviews, they must be clearly documented. And the documentation needs to include the assumptions used in arriving at the decisions. This review must also take into account all relevant information, including experiences with similar assets, the maintenance history of the asset, any planned future maintenance or future changes of the asset, and the planned future replacement. And these should be found in your total asset management plans. Condition ratings need to be taken into account. Other indicators, benchmarking against other entities, and similar assets across the sector. All these things can be taken into account in determining the remaining useful life. A well-implemented strategic asset management plan, or total asset management plan, is key in determining the useful life of your assets. But there also needs to be a consistency between the scheduled replacement of assets in these plans and the remaining useful life of the assets used by the accountants in calculating accumulated depreciation and future depreciation expense. This should also take into account the feasibility of replacement at that replacement date. Is there an expectation that the building or the components can be or will be replaced at that stage according to the schedule? Is the funding expected to be available? So essentially that's the theory of fair value. Current replacement cost, the aim is to estimate what someone would pay to buy or build a substitute asset with the same remaining utility or service potential adjusted for obsolescence. But there are some contentious issues in the implementation of that theory. And on this slide, there are simply 4 of them. The adjustment to gross replacement cost, componentisation, condition, and remaining useful life. Now, we have been looking at this over the last probably 6 months with valuers and with our own asset paper that we issued just before Christmas that went out to the CFOs and to the valuers. To measure the adjustment to gross replacement cost of the modern substitute asset, we have seen valuers adopt a variety of measures for measuring this adjustment over time. These adjustments have included applying a straight condition factor. So you look at the building, what condition is it in, adjust it based on that. Some have used a simple straight line. How old is it? How far through its life? Straight line, same as depreciation. Some use an adjustment for condition and then apply a straight line. But there's a 4th method that we prefer, which is to adjust for the excess or additional utility in the modern equivalent and then to calculate a straight line adjustment to calculate the written down value. So there's a cost to build a new building adjusted for differences in excess utility to form the gross value, and then adjust for age to find the written down value. To do otherwise, we contend, would overstate the reported value for utility that is not currently in place in the building in question. And we're currently going through with AECOM, Davis Langdon, the process that they use in that calculation. Componentisation. The accounting standards require to separately account for an item's parts where those parts have a significant cost and a different useful life, where they are material to the total asset. Sometimes this is not easy, especially where no one component is significant. But that's not to say that you can't group different components together where they have the same useful life and they would be replaced together. Componentisation can be a matter of judgment. But what we want to see is how was this judgment implemented? What were the assumptions used? And was the right balance achieved in that decision? Again, documenting that decision is essential. We need to be able to see it when we come into audit. What was done? Who did it? When was it done? And what was the outcome? The 3rd point on the slide is how condition affects fair value and useful lives. While it makes sense that to achieve the outcome of arriving at fair value, the asset's replacement cost needs to be adjusted for its current condition, the question is, what is the best way to achieve this? What is important is that a condition rating is not a proxy for consumption of service potential. We need to remember that depreciation is usually a uniform time-based allocation. And it allocates the cost of the building over time, over the use of that building. Across health, we use a straight line depreciation methodology. So depreciation is the same as you go through. Utility is consumed equally in each year. So the condition assessment is used mostly to estimate how far through an asset's life it is. But it does sometimes get complicated. And that is, an asset's condition sometimes degrades faster or slower than it was expected to. And that requires an adjustment in useful life. The timing and nature of preventative and reactive maintenance shifts. So where maintenance wasn't performed when it should have been performed or was planned to be performed has an impact on condition and thus on remaining useful life. All of these things can lead to a change in remaining useful life and a change in fair value. We also see difficulty experienced in the estimation of the current age of some assets or components, and this is often a result of incomplete or inaccurate historical data. Asset management systems do not always contain information in relation to when an asset or its components were last replaced or upgraded. And this makes it difficult to estimate the life of the asset or the component in question, and it can result in errors in estimation. The more complete and accurate the data in the asset management system is, the better valuation outcomes can be achieved. And while we can't change the data that is in there in the asset management system at this point in time, we can record better data going forward as refurbishments occur. And that will result in better valuations in the future. The fourth point in relation to current age, remaining life and likely replacement timeframes. How well does your agency demonstrate that the remaining useful life estimates of their assets reflects the actual time that those assets are going to be replaced? But is this remaining useful life consistent with when it will be replaced? Can it be replaced when you're estimating it will be replaced? Is there funding available? Is it feasible? All these questions need to be asked and documented. How did you arrive at those remaining useful lives, and are they consistent with both the asset management plan and future funding that is available? Now, an example of where limited future funding may impact on remaining useful lives was highlighted in our recent report to Parliament on efficient and effective use of high-value medical equipment. This slide is a graph that was contained in that report. It was on page 35. The columns represent the replacement cost of medical equipment. The black line that goes across, which I don't know how to point out, around about 70 million, is the funding available under the Health Technology Equipment Replacement Program. So that's the funding going to be provided through Treasury, through the department, each year out into the out years. As can be easily seen, the columns are a lot higher than that. So it's going to cost a lot more than what's being provided under the HTER program to replace that medical equipment. And this funding has to come from somewhere else. It has to come either as a grant or special funding from the department or self-funded through own source revenue. So when you review your remaining useful life of your assets, this needs to be taken into account. Is there funding available to replace it when it's planned to be replaced? Is there a need to prioritise some equipment to be replaced while extending the life of others? These decisions need to be documented. I guess I'm harping on about documentation, but it's that documentation of decisions that is often lacking. And when we come in to do the audit, we're told, yes, we reviewed useful lives, but there's no evidence that it's been done and what was taken into account. If we look at buildings, that graph shows the total life of buildings, and it's not in dollar terms, it's in number of buildings terms, in the different timescales. And while these numbers are a little distorted because of the use of weighted average useful lives in the valuation process, it shows that a majority of the buildings have a total life between 30 and 40 years. That's how they're depreciated currently in FAMIS. And that's because historically the nominal life in FAMIS for a building was 30 years. It may not reflect how a building is actually used, and that needs to be assessed annually on what the remaining useful life is. So the buildings start with a nominal life of 30 years when they commence, and then the valuation process pushes it out slowly. So you've got all those buildings in that 30 to 40 year bracket. So there's approximately 44% of health buildings in the health sector, have a total life, not a remaining life, but a total life between 30 and 40 years. Is this a correct reflection of how those buildings are being utilised across the sector? We can also see that 15% of buildings have a life that is greater than 60 years, a total life. So as they age, their total life gets extended and extended because they don't actually come to an end of life, they're just refurbished and they continue on. So that doesn't look as if it's had a proper review of useful lives performed annually over those buildings. But as we find new buildings come in, still with a nominal life between 30 and 40 years, even though there's a large number of buildings that are extended beyond that as they age. So do the useful lives of your buildings reflect their true lives? Or is it just the time they're going to need, before they're going to need to be refurbishing? Is it the life of the building as a whole, or is it simply the life of the internal furbishments? And in 30 years you need to refurbish, but the building continues. This has an impact on the calculation of depreciation expense. If the lives are too short, the expense is too high, and that can impact on the sustainability or what it looks like in your profit and loss statement. And it also means that an entity is forever extending the life of their assets because each year the life's extended. They do a review of the condition hasn't changed much, the life gets pushed out. If this is occurring, it's a good indication that the original estimation is incorrect, and there needs to be a closer look taken at those remaining useful lives that are in FAMAS of the buildings. And another question needs to be asked is, does the depreciation expense, which is booked each year, truly reflect the utility that is being consumed each year? Or is it too high because the lives are too short, thus making expenses too high? And that's all part of our discussions we're currently still having with AECOM, Davis Langdon, Damien Hirst. The key messages for management. Firstly, don't forget that reporting a fair value of assets is a key responsibility of the preparers of financial statements, including the accuracy of that valuation process. Not only are there expectations on financial statement preparers to understand the methodology and the assumptions used by the valuers, these expectations extend to ensuring consistency with the accounting standards and the non-current asset policies for the Queensland public sector, which were issued by Queensland Treasury and are better known as the NCAPs. It is better practice to document and to agree the assumptions which impact on the valuation with the valuer before they come up with their final valuation numbers. So these assumptions that have the biggest impact on the valuation include remaining useful life, condition assessments. Make sure management agree with what the valuers are using. The valuers don't always have all of the information available. They don't always talk to the people that they should talk to get that information. So while the valuer is an expert in valuation, they may not have all that information available. And we have seen financial reporting risks materialise in the past when the valuation process was undertaken in isolation from an assessment of useful lives. The assessment of useful lives in the valuation process needs to be done either together or very close together with the same people involved so the same assumptions can be made. But above all, please talk to us as early as possible. We're always accessible and we will listen and we will get back to you as soon as we can. And one last slide for audit committees. Again, we have questions that don't need to be answered here. How many audit committees have reviewed asset valuation plans for 2016-17? Do audit committees receive a full copy or a summary report from the valuer? Should they receive them, or is that just for management? Has any committee invited their valuer to attend an audit committee meeting to discuss their assumptions and their valuations? Do audit committees receive annual reports on asset useful life reviews? If so, does the committee question management on their assumptions? The audit committee recommends to the board to accept the financial statements and the valuation of assets. They need to be happy that the assumptions used are accurate and properly reflect how those assets are going to be used. And are there any questions? I think we're running a little bit longer than originally planned. Does anybody have any questions? I might throw over to Anthony.
Hi everyone, and thank you very much for the opportunity to be here today. And I realise we have run over, so I'll be brief. First of all, by way of introduction, as you may be aware, there's a giant-size acting in front of my title, Auditor General. At the moment, I used to think that being asked who audits the auditor was the most important question I got asked. It's now when's the Auditor General being announced, so that's overtaken it. It's kind of a bit like the Roman sentry on the wall. There has to be an Auditor General operating in the Queensland system of government. Buried deep in our legislation is that if the Auditor General leaves or even goes overseas or is incapacitated, that the Deputy Auditor General steps into that role and has all of the powers of the Auditor General. So to that end, I'm thoroughly enjoying my time as Acting Auditor General and pushing onwards and upwards, having been very focused on the strategy for QAO with Andrew Greaves, our former Auditor General. I'll touch quickly. I'd like to just close by putting what you've heard today into a little bit of strategic context. And you might see part of our little logo up in the top right there is down the bottom. It has the three words, Better Public Services. And a little over a year ago, I refocused our strategic plan from, I think it was Leaders in Public Sector Audit, which was very sort of inward, self-focused, to Better Public Services. Through the work that the QAO does, we hope to facilitate better public service delivery for the citizens of Queensland. And that's three very specific things to me. One, it's about maintaining the confidence in the financial reporting process. And so a lot of the things that you've heard today are about areas of focus that we see in financial reporting where we need to focus on and producing that audit opinion at the end of the day. The second area is around the efficiency, effectiveness and value for money of public service delivery. And so I have a performance audit program at my disposal to be able to look at different elements of service delivery, whether it be the high-value medical equipment that Alan showed the graph on and is it being effectively used, through to a range of different areas across government service delivery. Emergency department performance is another good example. The third area, and I think it's really the basis for today, and you probably haven't traditionally thought of this as your auditor's role, but in terms of achieving the better public services, for me it's about ensuring that the capability maturity of the sectors that we operate in is always moving upwards and improving. And so from the presentation that we gave around timeliness and quality, where you saw the performance indicators and the traffic light system, it's a very intentional way for us to be able to help focus on what's important around that. And you might have heard Damon in his opening welcome talk about campaigns. And that's an example of a campaign that we do. We'll focus on those as much and for as long as we need to do till we're comfortable that the particular sector that we're working in is achieving the right level. And then we'll look at more sophisticated and different areas to focus on. So I wanted to put that in a little bit of context. And across all of those areas, it's about having access to the specialised skills and capabilities. And we do that through our sector director. So QAO is established around sectors. So it's important to understand the auditing standards, the accounting standards and all the technical issues. But for us, we need to make sure that we understand the business context as much as we can. And so the role that Charles is acting in and Damon holds around the sector director role for health and the HHSs is your primary relationship point, so that we don't sort of, the way our legislation is structured, we have the potential to be very schizophrenic, helping on one side and being seen to swat you on the other side, potentially. And so the sector director is kind of like the marshalling facilitator that links back to you to provide the right amount of trusted and independent advice, to look for those performance audit topics of focus that you might find value out of receiving an independent perspective on, and where improvements might be able to be made. And also, unlike if you move into the private sector world and engage a consultancy, we're able to look and benchmark across all HHSs as well as other jurisdictions around Australia and around the world, if necessary as well. So in closing, and I'm sorry if I've sped through it, I've tried to do the quick version. I see the Audit Committee Chair's relationship for QAO as a very important one for us to help to achieve that capability, maturity, improvement, to maintain the confidence in the financial reporting of the public sector, and also for the efficiency, effectiveness and value for money of government service delivery. And so to that end, your sector directors are your key point. If there's any areas that you need to focus on, anything you're having concerns with, my intention there is that you're seeing them probably less in audit committees. That'll be the job of the managers and the engagement leads, and more in an ongoing relationship basis where you can test your thinking, get reference material, those types of things as well. I will just close on the related parties, and I know there's probably going to be a lot more discussion, and please feel free to talk to any of our team or myself during the course of the lunch. It is still landing, and to that end, around demonstrating the capability maturity side, we've been working fairly actively since before the standard has actually been set, providing feedback through the my counterparts, the ACAG group of Auditors General around Australia and New Zealand, to try and make it as practical as possible. With the standards now in place, we've been working with Queensland Treasury to balance the need for pragmatism with the need for us to be able to look at the accuracy and completeness of the related party information that's been put in place. And recognising that you sort of go through these sort of different levels of almost grief, if you like, around, hey, we've got to do these new related party disclosures. And, you know, I've seen quite a number of emotive responses around that through to now, okay, it's resigned to the fact that we've got to get these in place. And how do we do that? And I get a sense from the questions in the room, there's a little bit of both. The reality is we'll still be working through with Queensland Treasury to get the details, but what we will be doing is trying to get that balance right so that we can give you an unqualified, unmodified opinion around your financial statements, and that it's not overly onerous on that basis. So as the team spoke about, there's been plenty of information provided, and we'll get that out to you. But equally so, if you've got any questions, or, you know, in the case of actually wanting to get your board across it, whether we do that individually or engage with Queensland Treasury around you know, there still seems to be an issue here, we need to do more, we'll find a way to ensure that it's put through as simply and easily as possible. So again, thank you for your time, and really appreciate the opportunity to work with you. Thank you.